All right, let's finish this chapter out. Man, this has been a long, difficult chapter. We're almost there. Okay. Casual investors often don't have the time or the skills necessary to build financial models, either operating models or valuation models. Okay? Fortunately, we don't have to. We can use work done by professionals. People like me write research reports and publish them, present them to the public, let the public use that information. So an alternative way to forecast or to get a hold of projections is to use consensus of analysts' estimates. And there are lots of services that provide this. Sales and earnings estimates are available at services like IBIS and Zacks, and yes, Yahoo Finance. You can go onto Yahoo Finance and you can find estimates for year ahead, actually 2 years worth of revenues, sales, and earnings. And you can get a 5-year growth rate. Okay? And so what do? They poll analysts. They talk to analysts. They survey analysts who have put together these models. Up to 30 or 40 analysts will contribute this information to these services, and then this information is provided to the public. So what's our job as investors? If we're not going to do the forecasting ourselves, we have to determine if we think that the estimates being provided by professionals are reasonable. Are these estimates reasonable? Are they too conservative? Okay. If they're too conservative, then the company may have an opportunity to beat those estimates. Okay. Or maybe they're too optimistic. If they're unreasonably high, okay, then we could have an earnings disappointment, and that would be a real negative. Okay. All right. One last thing I want you to take a look at is using the macro approach to come up with multiples. Analysts often review the historical relationship between multiples for an individual stock and multiples for the stocks of similar companies, which is their industry or peer group, and multiples for a relevant stock market index like the S&P 500. When you compare multiples, you are creating what's called a relative multiple. How does Apple's multiple compare to the market? How does Apple's multiple compare to its peer group? If the multiples of one security are higher than what they are compared to the multiples they're being compared to, then the multiples are said to be trading at a premium. So if Apple's multiples are higher than the market, if Apple's multiples are higher than their peer group, then Apple's multiples are said to be trading at a premium. If the multiples of one security are lower than what they are compared to, the multiples are said to be trading at a discount. Okay? All right, so as you study historical relationships, consider how the outlook for the company, for the industry, or for the market compares to the historic relationship that existed. Can the company continue to outpace the industry and the market? The outlook includes earnings growth, interest rates, and factors that affect the business environment like regulation and competition. In other words, before you extrapolate historical relationships, consider what those relationships might look like in the future. All right, here's an example. All right, so here's Apple's PE, and here's the industry PE. So this is for the peer group, and here's the market PE. Now what we're going to do is we're going to divide Apple's PE by the industry PE, Apple's PE by the stock market's PE, the S&P 500 PE. Let's come up with an average. So over the last 3 years, Apple's PE has averaged 17.37. The industry, 16.24. The market, 13.72. And Apple's stock has traded somewhere between 1 times the industry and a 16% premium, an average of a 7% premium. Apple stock has traded at a 30% premium to a 16% premium at an average of 27% premium. Okay? So there we go. So Apple's stock ranges from 16% premium for the market to 35% premium, and their average PE 17.37. All right. After you establish this relationship, the 17% or the 16% premium to the 35% premium, okay, then you project the market, the multiples for the market and for the industry. Once you have forecast the multiples for the market and for the industry, then you use these historic relationships, the 16% premium to the 35% premium, to come up with your multiple forecast for the stock. This is just another way to determine whether your forecasts are reasonable. All right. For example, if Apple's PE ranges from a 16% premium to a 35% premium to the market, and you forecast that the market's PE will be 18, then Apple's PE will be 16% times 18, which is 20.88, to 1.35 times 18, 24. Somewhere between 21 and 24 would be the historic range relative to the S&P 500 PE. So when you go to pick a multiple for Apple, you need to compare the multiple you pick with the multiple for the market to see if it is reasonable. Okay? All brokerage firms publish their estimates for the earnings for the major stock indexes. They all tell you what they think the stock indexes will earn next year, and if you divide the current price of the market by their earnings estimate, you get the PE. Okay? And they'll give you an opinion of what an appropriate PE ratio is for the market, should be for the market. All right. Most large companies have more than one profit center, multiple products, multiple divisions. Therefore, to accurately value a company that has multiple profit centers, the multiples, not just the PE, but the multiples that you employ should reflect the different businesses that a company is in and the different valuations that the market assigns to each business activity. What do I mean by this? All right. The first step is to compute the percentage of sales and earnings of the various profit centers. Okay? What percentage of sales and earnings does each profit center represent? Then we'll look at the multiples of the stocks of companies that are in the same or similar businesses, okay, as these profit centers. Then we'll find a weighted average. All right, let's take a look. Enough of this nonsense. Let's get down to it. Okay, for example, Apple has a significant cell phone business, a significant PC business, and a significant operating system business. So Apple is in 3 different businesses, okay? Cell phones, PCs, and software, okay? So we're going to look at the multiples, not just the PEs, but the multiples of stocks in those industries, okay? Okay, that's what we would do. As we're not going to get into too much detail, but let's say that Apple's cell phone business is 50% of their business. Let's take a look. Let's see if we got it. Do we have any? Yeah. All right. Let's say that Apple, their cell phone, is 50% of sales and earnings, and that the cell phone industry typically trades at 20 times, and their PC business is 25%, and their operating system business is 25%. And let's say the PC business sells at 10 times, and the operating system business sells at 30 times. Okay? All right, so we're going to multiply the percent of the business times the multiple. So that's 10, and that's 2.5, and this is going to be 7.5. Just so happens that the multiple for Apple should be 20 times, which consists of the cell multiple, the PC multiple, and the operating system multiple. Okay? All right. Once you compute your intrinsic value, you must compare it with the current market price. If the expected return is greater than or equal to your required return, remember what our required rate of return is, it's our CAPM or our Gordon, I think it was 12.1%, okay? then we buy it. So the expected return is equal to the intrinsic value plus any dividend that we expect divided by the current market price. Okay? Once the decision is made, once you buy the stock, you have to monitor your assumptions about cash flow and about multiples, and you monitor the stock price in order to determine a future action. When to sell, could be when to add more to it. Remember, you have to update your intrinsic value as new information emerges. Once you go through this entire process and you get a quarter down the road, 3 months later, and new information comes in, you have to consider updating your entire model. Okay, you asked for it, you wanted to know how to price a stock, and now you know how to price a stock. We'll move on. Think about it. Shalom.